Assalamualaikum warahmatullahi wabarakatuh, and a very good day. My name is Dr. Muhammad Muhaizam bin Haji Musa, and I will be conducting this session with you. Now, what we're going to do is that we're going to discuss a topic on measuring the bank's performance. Now, we want to continue what we have discussed in the class, which is first of all, let us discuss the bank condition. There are actually several conditions which we can use the name camels. So number one is capital adequacy, number two is asset quality, number three is management quality, number four is earnings or profitability, number five is liquidity, and number six is sensitivity to market risk. Now, all of these conditions are very important to highlight how banks can perform. Now, let us look into the next slide. Basically, capital adequacy represents reduced risk, which is very important to have a capital adequacy. So, if a bank condition of capital adequacy is not enough, then it will make the bank not performing well. So, that is why the reason to have capital adequacy is to reduce risk, to absorb losses, to support the financing and operation of a bank. The function next is to provide protection to depositors and other creditors, and also capital adequacy can be used as a public confidence. Now, next condition in the bank is asset quality. Now, it is about determining the current and future profitability of the bank. So it is an indicator of how the quality of the asset that the bank has. So basically, usually loans exhibit the highest default rates. Hence, if NPL or non-performing loans increase, the asset quality of a bank will deteriorate. So that is the direct effect to asset quality. Now, next is about management quality. That is the third condition. So, management quality is about the management has an overview of a bank's operation, manages the quality of loans, and has to ensure that the bank is profitable. Now, the next condition is profitability. So, profitability condition is very important to tell the bank's performance. It is the most important indicator towards bank's performance, and usually profitability can be measured as return on asset or ROA, return on equity ROE, and net interest margin. Now, the next bank condition is liquidity. So how does liquidity looks at to tell about the bank's performance? So basically, the use of the bank liquidity is to meet deposit withdrawals and satisfy customer loan demand. Liquidity here refers to how fast and how easy an asset can be converted into cash. If a bank suffers financial distress of any reason, asset liquidity can be reserved that the bank can withdraw on in and the event it access the purchase fund, it reduces. So very important to have liquidity in order for the banks to be able to meet their current situation or demand quickly. So that is the reason to have liquidity. Now, the next is sensitivity to the market risk. So, in this condition is that what we need to know about market risk. Basically, the banks are always exposed to market risk. For example, in movement of interest rate. Because why? Because most of the bank's product and also most of the investment that the bank have in their asset or their sources of income, basically they put that in the money market. which earns interest, and that is why they are exposed to market risk. Because the market risk is all about the changes in the interest rate that will affect the market value of a security such as bonds, money market, and treasury bills. Now next is external performance. As what we learned before, we have two ways to look into performance, internal and external. So the external performance is basically the market risk, the market share, regulatory compliance, and public confidence. Now, basically, market share is the shareholder value of the bank, whereas the regulatory compliance relate to how much the reserve that the bank have created, and also looking at their bank's lending policy. So that is what external performance is about. And finally, looking at what is the public confidence towards the bank based on the current situation of the bank, public image, for example, and also looking at the situation in the country policy on deposit insurance, because these are why external risk is looked, because this is something where the performance of a bank cannot be controlled by the bank. That is why it is called external performance. Because, for instance, market share, the bank doesn't control the movement of the prices of the share, because the prices of the share is determined by the supply and demand of the prices in the market. The investors buying or the investors selling pressure. So that is why how movement of the prices is not controlled by banks. And also regulatory compliance. Regulatory compliance is being determined by the central bank, and public confidence is what is the opinion of the public. So banks cannot have the control of it, so that is why it is known as external performance. So it's very important for banks to make sure that they are able to perform in these three areas, so that it can be make the bank achieve their profitability in terms of performance. Okay, so we have here the profitability ratios, surrogate for stock value. So we want to see that firm performance is basically being represented by the stock prices, where when a bank issue shares to investor, right, they create stocks, and these stocks is being invested in the capital market. For example, in Malaysia, it is being traded in the Bursa Malaysia. So some of the banks in Malaysia collect money funding from the investor when they issue shares, and investor buy the shares, and the buying and selling of the shares is being done in the stock market, and in Malaysia it is where Bursa Malaysia. But for this condition of share prices, this is basically not a reliable indicator for performance for the banking industry. Now the reason is that the banks, not all the banks in the industry have issued share stocks or share. So because some of the banks, right, they like to control the issuance of equity. So usually not all banks will have share prices, and therefore what it is going to be used as an indicator of performance is that we're going to use profitability ratios to indicate to surrogates, which is to exchange the assessment to the market value indicators. So let us look at what are the key profitability ratios in banking. So these are the several ratios that can be used for determining the profitability of banks. So number one is the ROE, or return on equity, ROA, which is return on asset, net interest margin, net non-interest margin, net operating margin, and earning per share of stock. Now let us look a little bit of some of the ratios here. So basically, the return on equity, or ROE, is measuring the rate of return flowing to the bank's shareholder. It approximates the net benefit to the stockholders have received from investing their capital in the bank. For example, the stockholder give their money to the company, to the bank, and their fund is actually at risk, and the stockholders are hoping to get some profit that is commensurated with their capital that they give to the bank. So in order to see this portion, it is measured by return on equity. Next is about return on asset. Now, return on asset is primarily an indicator of managerial efficiency. It indicates how compatible the management of the bank has been converting the institution's asset into net earnings. So basically, the ROA tells how the strategy that the bank made by the management team, usually is led by the CEO or the Chief Executive Officer of the bank, are able to utilize their asset that the bank have, and the assets are able to generate money or profitability. And this is why it is being measured by return on asset. Look at how well the assets are generating income. Example of asset that the bank can actually generate income is, for example, in terms of their money that they have kept with other banks. So that is what is generating income. Right? Their savings with another bank, the cash that the bank have kept in another bank's vault. So that are some of the examples of asset that is generating returns. So basically, we have others like net operating margin, net interest margin, and non-interest margin are considered efficiency measures as well as profitability measures. So it's very specific. The measures indicate how well management and staff have been able to keep the growth of revenue, which are primarily from the bank's loans, investment and service fee, ahead of rising costs, principally the interest on deposit and money market borrowing and employee salaries and benefit. And we have others ratios, but I would like to go into the next slide, which I want to discuss here as our final view on the ratios. Now, in also determining the performance of the bank, there are also other things that is measured that is related to the bank's performance, which is risk. The risk is also an area where a bank will see whether or not it will impact the bank performance. So we would like to learn about some of the risks that we can see, and some of them are listed in this list. For example, credit risk, liquidity risk, market risk, price risk, interest rate risk, foreign exchange risk. We have off-balance sheet risk, operational risk, legal and compliance risk, reputational risk, strategic risk, and capital risk. Now, here for today, we only going to look at two very important risks that is going to impact the bank's performance, which is the credit risk and liquidity risk. So what are they? So basically, here, credit risk is about the profitability that some of the bank's assets, especially its loans, will decline in value and perhaps become worthless. So that is what credit risk will happen, because it revolves basically as a use to look into non-performing of asset divided by the total loans of leases. There are also net charge of loans divided by the total loans and leases, or another formula is annual provision for loan losses divided by the total loans and leases. So that is the measure of credit risk. So credit risk basically tells about related to the bank's lending activity to customers. So we have here other example. Okay, now as this ratio grows, the regulator may become more concerned. Means that the higher the credit risk increase after the calculation, this will create concern for the regulators, because the number is increasing, means that the higher the credit risk is exposed in the bank. So it is not a very good situation. Now let us look into the last performing, which is liquidity risk. Now what is all about? Liquidity risk is about the danger of not having sufficient cash and borrowing capacity to meet customer withdrawals, loan demand and other cash needs. So basically in low risk, it's about low liquidity will force bank to borrow emergency funds at excessive cost to cover its immediate cash needs, and this may reduce its earning. So it's not good for when the bank is having a low liquidity. Final statement. Some useful ratios to measure liquidity risk are, as stated here, we have the what is this amount, right? This are the things that can be measured the liquidity, and also cash and due from balance held at other depository institution divided by total loans. So these are among the ratios. Now, before we end this video, right, I would like to see this slide. Now, why banks fail is that most recent studies have identified a few factors that most failing banks seem to have in common. Number one, they have a problem in their loan portfolio, which is as stated below. Okay, and number two is economic condition. Right. So this is some of the features that we'll look into in our next lecture. So thank you very much for listening to this video explanatory narration. So, Assalamualaikum, selamat sejahtera.